we don't have the live stream picking the wrong conversations. All right.
Hello and welcome to the Scan the Markets webinar with myself, David Madden. I'm a market analyst at Equity Capital here in London. And Equity Capital is one of the groups, one of the companies within the overall equity group. An equity group obviously contains Equity Nigeria, and FX Pesa in Kenya. For those of you who are joining this webinar for the first time, basically what I'll cover is I'll do a quick rundown of the major events of the major markets, talking about what's going on, what's driving them from a fundamental point of view, the news, and also from a technical analysis point of view, the study of charts. I'll be running through about 5 charts in this webinar, and of course, if you have any questions for me when I'm on a particular chart or on a certain topic, feel free to just get in contact and and just ask me to clarify the point or happily go over it. Also, if there are any markets that I haven't covered that you want me to take a look at, or say, oh, David, what's your opinion on silver or whatever it might be, any particular markets you want me to do a bit of analysis on, feel free to just shout that out as well in the chat box. So hopefully everyone can see me okay and hear me okay. And if you have any issues on the audio, any issues on the visual, feel free to just message away in the chat box. So starting off here, looking at the euro dollar. Obviously quite an interesting time for the currency pair. Just to let you know, I'll be looking at the time frame I'm using is a 4-hour window, and I have 3 moving averages on the screen here. I have the 20 period moving average, this one here, the 50 period moving average, this one here, and the 100 period moving average, this one here. So as you can see, euro dollar has been in a fairly sharp and aggressive downward trend. In fact, euro dollar, the currency pair, has fallen to a fresh 20-year low. So which really highlights how bearish the move is. In fact, we've actually traded below parity, and we still are trading below parity on the currency pair. So it really kind of speaks to the aggressive downward move that we're seeing in euro dollar. Well, what's going on? Well, there's a couple of factors going on. We have a strong US dollar and we have a weak euro. What's surrounding the euro? Well, there are concerns about inflation in the United States, as there are elsewhere. Inflation in the US is running at 9.1%, a new 40-year high. When inflation increases, central banks, the Federal Reserve, typically respond by hiking interest rates. We've already seen a few rate hikes from the Federal Reserve. We're expecting another large hike this month, which would probably be a 75 basis points hike. The markets are already factoring in quite a high probability of another 75 basis point hike in September. What's also hanging around and what's also fueling those inflation fears today was today's Ppi report. Ppi is producer price index, CPI being consumer price index. Everyone always talks about CPI because it affects every individuals on the street, consumers, but in everyday conversation or everyday kind of economics for people, for ordinary citizens, you're not in finance, PPI doesn't get really talked about a huge amount, but it is quite interesting because PPI is what is essentially the measure of change of cost for producers. Now, if the producers are experiencing higher rates of cost, chances are that's going to be passed on to consumers. So PPI can often be a leading indicator for future CPI. So with the fact that we had an uptick in PPI today in the US, it went to 11.3%, close enough to its record high. That kind of sparks fears. Oh wait, maybe CPI is going to tick up again in 1 month, 4 months, 6 months down the line. So the overall story that's added to a stronger US dollar. What's going on in the Eurozone? Well, there are concerns that the Eurozone could be heading towards a recession. There are concerns that Germany, the largest economy in the Eurozone, could be on track for a recession. And what's also more of a kind of a pressing point for the Eurozone is the fact that Eurozone leaders are already kind of bracing themselves for the possibility that Russia might turn off the gas in winter. It may not. It might happen. It may not happen. But the very fact that they're talking about and kind of putting and somewhat preparing themselves for that such a that possible event, that really kind of just underlines the kind of the vulnerability in the major economies of, say, Germany and Italy, and to an extent the Netherlands, who are all fairly large, particularly Germany and Italy, who are large importers of gas from Russia. So a mixture of all that has led to a very aggressive sell-off, a 20-year low below parity on euro dollar. What's going on in terms of the price action? If we take a look at the price action in the last 2 hours, it's been moving aggressively lower. While the currency pair, if we look at the MACD indicator here, which essentially is a measure of momentum, momentum is in positive territory, but there's been a steady decline in positive momentum. It's very much fading here. And the fact that it's positive momentum is fading suggests the bulls, the buyers, are running out of steam. And if we look at the RSI, essentially kind of measures relative strength index, essentially kind of measures kind of, is the market overbought? Is it oversold? Or is it somewhere in between? And if it is somewhere in between, kind of which end is the bias towards? And the fact that the RSI itself is moving lower in the last few hours suggests the price bias is to the downside. We can see here that RSI moved below this dotted line along this dashed line along here, indicating a move into oversold territory. That can often be a warning that a change in trend is in the offing. There are no guarantees, but sometimes it is. And we can see here that when it moved into oversold territory here on this occasion here, that actually predated this rebound that we saw here within a few hours, or within a few days rather. This was the price action that we saw here on the RSI. It moved into oversold territory, kind of acted as a warning that the market's overstretched to the downside. And lo and behold, we saw a fairly sharp rally, but that rally didn't last, and we fallen into a new 20-year low. In fact, we fallen below parity. So while euro dollar continues to hold below these three simple moving averages, it's likely the more medium-term downward trend will continue. Moving lower from here, we could be looking down towards 0.9900, and a break below that could see us down towards 0.9800. Now, markets don't move in straight lines. As you've seen here, we saw a fairly decent rebound of the currency pair here, a modest rebound here. We saw a bit of a rebound here. We saw a fairly large rebound here. If we look, it's good to monitor past price action and kind of use that as a gauge, as a rough idea of what could happen in the future. So we can see here that from time to time, after moving aggressively lower, there's been a few occasions where we then kind of snapped back, only to move lower again. So if we do get a rally in euro dollar from here, where could we go? Well, I'm looking toward this peak here in around 1.0121, and a break above that could see us up toward this zone here around 1.0220. It's only really if euro dollar was to actually have a decisive break above this moving average here, the 100 period moving average, and that comes into play in around 1.0325. It's only really if you have a decent break above that, would then I begin to think, okay, maybe the currency pair is turning around. Looking here at the US 500, the S&P 500. So there's been a few things going on. I talked about the high levels of CPI, high levels of PPI in the US. That's fueling fears that the Federal Reserve are going to continue to do large interest rate hikes. Who knows? They may even actually do an even larger rate hike, either later this month or possibly in September, depending how things play out with regards to inflation. What's also going on? The U.S. economy is still growing, but at a slowing rate, and there are fears that the U.S. economy is cooling and cooling. Who knows? It might even slip into recession, because if prices remain high for a prolonged period, that chips away at demand, because if inflation is running at over 9% in the US, that's chipping away at people's disposable income. That might cause consumers to tighten their belts and not spend as much. In that scenario, that kind of essentially takes money out of the economy, compounding the problem of a slowing US economy. And who knows, it might even actually tip it into a recession. So what's interesting with the US 500 is we can see here by the price action, it was enjoying a fairly sharp rally up until last week. But notice how the peak that we saw last week didn't actually retest or break above the peak of late June. So that was kind of your first inclination that, okay, maybe things aren't as bullish as initially seemed. Then we've been turning aggressively lower this week, particularly the last couple of sessions. And now what is of importance is the lows we've set in the last few hours have broken below the lows of early July. We're now back down to levels last seen in late June. So we're back down to around 10-day, 2-week lows. And that in itself is fairly significant. So it was only a week ago, we were not too far away from retesting a peak. Now we're hitting 2-week lows. Taking a look at the RSI, we can see there's been a steady increase in negative momentum. So not only are the bears in control, they seem to be becoming more and more influential as this market unfolds. I talked about the RSI and the previous chart. There's been a sharp move to the downside on the RSI, indicating that the price bias is lower. Because if you look at the previous, always be kind of looking at the price action and the RSI. We can see here in this period here where RSI was moving higher. We can see here, you look at the RSI, you can always chart RSI as if it were an actual market itself. It's not uncommon to see this kind of behavior. The market's moving higher here, and we can see a rally in the RSI. Take a look at the more recent price action. We can see a downtrend in the RSI here. And how does that fare out when we take a look at the price action of the actual market? The market's moving lower. So the RSI and the price and the RSI typically move in the same direction. If you see one moving one direction, another moving the other direction, that can often be a sign a change in trend is in the offing. But when we see the price moving lower and we can see the RSI moving lower as well, we can then be more confident that the downtrend in price is going to continue. What is worth noting, the RSI actually bounced off of the oversold territory. So we have seen a bit of a turnaround. It actually moved into oversold territory. We have seen a bit of a rebound. If we do with this could be the kind of the flash warning to say a bit of a bounce back in the US 500. The actual price of the market is in the offing. So in the near term, while we continue to hold below these 3 simple moving averages, it's likely the near term, medium term downward trend will continue. Moving lower from here, I'm looking to retest 36.89, and a break below that would take us back down toward this low here of 36.35. Keep in mind the low here in mid-June, I believe, was either an 18-month low or even a 20-month low, but it was a very significant low. So if we break below that level, we'd then be looking back down towards a 21-month low or perhaps even a 22-month low, and that in itself would be a fairly significant. We're moving lower here in terms of the price action, but we're still holding above the lows of latest June, and we're definitely above the lows of mid-June. So we're now asking ourselves a question: is this market just going to have this negative move lower here, just the market handing back some of the previous upward rally, or is it a case of the market is actually turning lower and we are going to go lower from here? We've talked about levels to watch out for to the downside, but at the same time, let's take a look at what's going on the upside. If you follow this moving average here around the 100-period moving average, it acted nicely as resistance here, it acted nicely as support here, consolidation zone here, it acted as support here. So there have been a few occasions where that metric has been of importance, and what I often say in relation to moving averages or any kind of be it trend lines or be it support zones or resistance areas, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So what I'm saying is that if it's recently acted as resistance here and support here, it might act as resistance again. So if we do get a rally in the market, where can we target? Well, that moving average comes into play around 38.26, and a break above that could see a target this peak here at 38.68. Coming on now to gold. Well, there's relationships in the financial markets don't say permanent, as nothing really does, but for the last few months, there's been quite a clear inverse relationship between the US dollar and gold. Gold is traded in US dollars, so when the US dollar is very strong, it typically puts downward pressure on gold, and conversely, whenever the US dollar is weak, that typically helps gold. Why is this? Well, if you're coming from the UK or the Eurozone or Japan or whatever it is, and you need to cash in your domestic currency to get your hands on American dollars so you can buy gold. Well, if you're Japanese yen, your euros, your British pounds, if they're buying fewer and fewer US dollars because of the strength of the dollar, then all of a sudden gold becomes relatively more expensive. And then the other side of the coin is if the dollar becomes weak, your Swiss francs or your Australian dollars buys you more US dollars, and therefore you can buy more gold. So I talked about how there are concerns about high levels of inflation, the prospect of even more large interest rate hikes in the pipeline in the US. With that, we've seen a very strong US dollar. In fact, the US dollar index has hit its highest level in 20 years. I mentioned a moment ago as well how euro versus the dollar is at a 20-year low. So it's kind of like the inverse almost of the euro dollar index. So the strength in the US dollar has driven gold down to a 1-year low. We're back down to levels last seen, well, actually even longer, back down to levels last seen, I believe in August last year. So it's kind of, we're talking about an 11-month low being set for the gold market. Yeah, the first week of August. So we're talking almost a 1-year low has been set on gold. Why is this? Well, partially the strength of the US dollar, but also the relatively high yield of government bonds. One of the factors is that the US 10-year yield, which is the US 10-year government bond, the yield on that, the yield or the return on that government bond is around 3%. The last time I saw it, I think it was around 2.98%. It's around 3%. So if you have your big pool or your big pool of cash and you're looking at how you're going to divide up your portfolio, now that you look at something like gold and you see it's in a downward trend, you see gold doesn't pay any interest, gold doesn't pay any dividend, so it makes it less and less attractive to hold gold. Whereas, historically speaking, if people want to put their money into low risk assets, they might put cash in a bank account. Interest rates are going up, therefore savings accounts are starting to kind of actually properly pay interest again. Government bond yields are rising. The US 10-year yield is there about 3%. So people are not going to go, well, in terms of what's considered to be a safe haven or a safe-ish investment, why would I put my money in gold? So as government bonds continue to rise and rise and rise, that will probably take away to a certain extent some from gold's appeal. Hence why we've seen gold drop to an 11-month low. Looking here at the MACD indicator, we can see momentum has swung from positive territory to negative territory, indicating the bears are now in control. There's a sharp move to the downside in the RSI, although it has rebounded off the oversold territory. While gold continues to hold below these 3 simple moving averages here, it's likely the more medium-term downward trend will continue. Moving lower from here, we could look to head back down towards this area here at 1678. And if we go below that again, we could be heading back down towards 1641. So we could be looking at heading back down to levels last seen in around kind of March 2020, so in the kind of early days of the pandemic. Looking at the other side of the coin, we already have seen gold has managed to kind of rally a small bit. It's off its recent lows. We can see here that it briefly moved into oversold territory, which could be the kind of almost like the flash warning to say that things are overstretched to the downside. The sell-off is overcooked. We see that's the sort of thing, rightly or wrongly, it might lead some people with short positions to close off the short position. It might encourage some people who want to bargain on to buy the dip to buy into a market, because if they see, RSI's briefly moved into oversold territory, that could act as if a warning to say maybe the sell-off is overstretched. That doesn't always work. Always monitor previous price action. Gold here had a very aggressive sell-off very recently. You can see here moved firmly into oversold territory here, but still we didn't see a rebound. We saw the market kind of trade sideways for a bit, only to move lower yet again. So with that, That's why I wouldn't necessarily always deploy the strategy of saying some traders, especially new traders, make the assumption if it moves into oversold territory, the market will automatically rebound. There's no guarantees that it will. So this is what I mean about always be monitoring and paying attention to previous price action. So if you do see a rebound in gold, because let's face it, we saw a fairly sharp rebound here, we saw a spike here, we saw a bit of a really decent rebound here. Where can we look to potentially target? Well, I've been looking towards the 20-period moving average here. This moving average here, it followed around on a few occasions. It's sort of acted resistance along here, not perfectly because the market actually traded above it on a few occasions. It actually has a bit of a kind of a consolidate or resistance zone in this area here. It acted nicely in resistance on these occasions here. There's a very aggressive move to the upside only in the last 24, 48 hours here where gold made a decent rally above the 20-period moving average, only to kind of give up the ghost and turn lower once again. The market's moving lower. So if we do see a rally in gold, I'll be looking for this area as a potential resistance zone in around 1727. And if we break above that, I'll be looking toward this peak here around 1745. Coming on, excuse me. Coming on now to the DAX, the German stock market. Some of the issues that's impacting the German stock market is the same issue that's impacting the euro. It's also impacting, let's say, the likes of the S&P 500. Once again, there are concerns. Something like 55% of Germany's gas imports come from Russia. So the fear is that what if Russia were to intentionally, even for a small period of time, turn off the gas into kind of mainland Europe, into Central Europe, into Western Europe? How would that impact the likes of Germany and the other major economies of the Eurozone? That's a factor that's hanging over it. What's also a factor that's hanging over the DE30 is this kind of general fears. The German economy is still growing, but it's growing at a slower rate. Inflation in Germany, well, it's ticked down ever so slightly, but the second last reading of German inflation was it's at a 50-year high. So a combination of, broadly speaking, high levels of inflation, really high inflation, and slowing growth, that kind of feeds into a situation of where, once again, high levels of inflation will continue to chip away at demand. Looking 1 month, 3 months, 6 months down the line, what can we expect to see with the state of services, construction, retail, manufacturing in Germany? If prices are high, that'll probably chip away at demand. So there are fears that Germany, at best, will slow down, at worst, go into recession. So notice how the price action here on the DE30 isn't too dissimilar to the price action seen on the S&P 500, whereby we had the S&P 500 make a decent enough rally here. It was only up until the 8th of July. We were actually moving higher on the US 500, and then only to move lower. And notice how the lows that we've printed up on the S&P 500 are back down to 2-week lows, where on the DE30 it's actually more pronounced. We had a decent rally here. It was only up until the 8th. We had a decent rally, but you can see here we've had an aggressive move lower, and we're now back down to levels last seen in early July. So things are looking, things are looking reasonably bearish as far as Germany is concerned. We're below all 3 slip moving averages. There's been a sharp move to the downside in the RSI. There's a steady increase in negative momentum on the MACD indicator, suggesting the bears are in control. So if we do continue to hold below these 3 simple moving averages, it's like it's a more medium-term downward trend will continue. Move lower from here, could see it retest 12,385, and a break below that could see us back down towards 12,228. Now, the RSI is moving lower. For all we know, it might move into or kind of retest oversold territory. If we do see a rebound in the price of the DE30 from here, where could we potentially see resistance come into play? Well, I've been looking towards this moving average here, the 100-period moving average. It acted very nicely in resistance only 1 week ago, and also just only a few days ago. So we can see here that this moving average here, and if you follow it around, it acted nicely as support here, and acted nicely as support along here as well. So there's been several occasions in the past couple of months the 100-period moving average has been significant, be it as support in May or else as actually resistance in July. So as I mentioned before, if a metric has been of importance in the past, it makes it more likely to be of importance in the future. So if you do rally in the T30 from here, this once again may or may not act as resistance, and that moving average comes into play in around 12,888. If you do break above that, that could be a sign that overall market's turning around and it's trying to shake off the much longer term downtrend. If you do rally from here, the next level I'm watching out for is this peak here around 13,172. Any questions so far? Because what I'll do is I'll be coming on to the US dollar versus the Japanese yen now, and then after that I kind of throw the meeting open to other markets that you want me to take a look at. So I've already been talking about how we've had a very strong US dollar, high levels of inflation, 40-year high, a surge, a renewed rally, a renewed gain in US PPI, which leads traders to believe that CPI will probably continue to move higher. That's been the driving factor behind the US dollar. Japan, the Bank of Japan has taken the kind of very much opposite strategy to the Federal Reserve. The Fed have already hiked interest rates 3 times this year in the last 4 months. They're expected to do another large hike this month. They're already looking at the markets are assuming that they're going to have even another large hike again in September. Whereas the Bank of Japan, the Japanese central bank, they're very much sitting on their hands. They're very much kind of keeping their monetary policy ultra loose. So we have a combination of a very strong dollar and a very weak Japanese yen. So with that, those two situations combined has driven up dollar yen to its highest level since 1998. So we're talking, 24-year high thereabouts on dollar yen, which really speaks to how bullish the overall trend is if it's at a 28-year high. We can look at the MACD indicator here and see momentum is firmly in positive territory. The RSI is moving higher. It's actually moved into oversold territory, which we'll come back to in a second. And we're firmly above all 3 simple moving averages. So if the broader, when we continue to hold above these 3 moving averages, I suspect the more medium-term upward trend is going to continue. A rally from here could see a target 140, 142. These are the next big levels I'll be looking out for to the upside for dollar yen. I mentioned about the RSI being overbought. It's moved into overbought territory here. This could be the kind of flash warning to say the rally's overcooked, the rally's overdone, it's overstretched. No guarantees that it will be, but it might be. And this is the sort of thing that traders look at. Some traders anyways, like I said, some people rightly or wrongly will open a short position whenever a market moves into oversold territory. Other people, rightly or wrongly, if they're already long and they're enjoying the rally, they might actually use the fact that the RSI has not moved into overbought territory as a kind of a signal to exit their long position, sell the market, and cash in their chips. Rightly or wrongly, I'm not saying every trader does. I'm not advising one way or another, but I'm just saying that that's what some people do. If you look at the previous price action of the RSI, we can see here that the last time we had a fairly clear peak in RSI was in late-ish June, and we can see here the market, it coincided, the peak of the RSI coincided with the market peak, and then we had a bit of a pullback. But looking at previous price action here, you can see how we moved firmly into overbought territory here, and we only saw a small bit of a pullback before another aggressive move higher. And if you look at this price action here, we've moved further and further and further into overbought territory all the way along here, but the market kept on going up. So this is what I mean about how there are no guarantees about, the market's in oversold territory, therefore the actual currency pair is going to fall, or we're in overbought territory, therefore the market's going to fall. This is what I mean about, especially for those of you who are new to trading, I would always be looking at recent price action and seeing what's going on. And if recent price action has a bit of consistency to it, then you can be a bit more confident that same kind of pattern is going to play out in the near term. That's why, because I know some people, like including myself, when I was new to reading about technical analysis and reading about the charts, you think you've kind of got something figured out. Oh, the market's overbought, therefore the dollar yen's going to fall. If only it were that simple. But if we do see a bit of a pullback, because let's face it, we recently hit a new multi 24-year high. We have, the market has prone to the odd pullback, albeit not very large pullback, such as here, here, and here. If we do see a pullback, where could we potentially find support? But I'm looking toward the 20-period moving average here. If you follow it around, acted nicely as support here, sort of acted as support here, not perfectly, acted as support along here. There's been several occasions in the last few weeks and months where the 20-period moving average has acted as support, not perfectly, but more often than not. So if we do see a move in the downside, we could find support coming to this zone here, and that's in around 137.64. What's interesting is, though, you can be more confident of a particular price zone if that price zone is where two or more other metrics overlap. So we can see the moving average comes into play around 137.64, but if you look at the price action here, we can also see this zone kind of acted as resistance on the way up. This was a bit of a resistance zone here. This was a bit of a resistance zone here. It's possible that all resistance could become a new support. And why is it important when two or more metrics overlap? Well, some people out there, like me, will give credence to both, support and resistance zones, and also to moving averages. But other people out there, they won't look. Excuse me. Some people out there won't pay attention to moving averages. Some people out there won't pay much attention to support and resistance zones. So the people that do pay attention to support and resistance zones, they may or may not be kind of waiting in the wings to buy the dip, and they'd have clocked this previous resistance zone and thought this could act as new support. Some people out there will be paying attention to the fact that the 20-period moving average has more often than not in the last couple of months acted as support for dollar yen, and look to actually place limit buys in there. So when the two of those are combined, that makes that kind of price zone all the more important, because you potentially have the buy the dip people coming in from both these people who identify support zones, but also from people who identify moving averages acting as support. So keep an eye out for that zone there around 137.64, and then this moving average here, the 100-period moving average, it acted nicely as support here in early July. It wasn't perfectly active as support, but there are two good occasions here where the market drifted a little bit below the moving average, the 100-period moving average, only to rally again. So I'll be looking out for that area, that moving average, and that comes into play at 136.08. Well, I got a question here. How does someone deal with psychology in trading? There are hundreds and thousands of textbooks out there on trading psychology. There are going to be podcasts covering it. There's going to be YouTube videos covering it. There's going to be articles written about it. There is a huge amount of psychology involved in trading, and as someone who's been in the markets for over a decade, and has also been reading about technical analysis now for about 4 or 5 years, there's a huge amount of psychology involved. My advice would be to kind of read about, do as much outside reading as you can, between textbooks, between podcasts, and between listening to interviews with well-seasoned traders, but also observe your own behavior, because, like I said, I wouldn't have necessarily time to kind of cover a huge amount on this particular question, but you can enter a trade. You can enter a trade and think to yourself, I'm going to buy dollar yen, for example. And if things are going your way, trading psychology doesn't really come into it. Psychology really comes into it when the markets are moving against you, and how do you react to that? That's kind of the shortest way I can put it. Fair enough, there is an element of trading psychology when the markets are going your way, but I typically have a game plan whereby I would look at a market. I would say to myself, where do I want to exit the market in terms of take profit? Where do I want to place a stop loss? Where do I want to cut my loss? Where do I want to have my entry price? And I would be disciplined, and I would actually wait for all those kind of three to align. I would look at my various analysis, be it fundamental analysis, charting analysis. Are similar markets moving in a similar direction? Is there recent is the recent history of certain price patterns replicating themselves, what's the overall sentiment, and then enter the trade. And then in that scenario, I would then be disciplined to say, right, I'm going to get out. I'm going to wait for the market to come to me. So I only want to be in the market at a certain price, and then I'm going to have a disciplined stop loss at a certain price and say, if it falls to that level, I'm going to cut my loss and get out and then reassess. And at the same time, I'll have a limit to take profit, which I won't move. And I'll happily close out whenever, even when the market gets there, and leave it at that. And then go on to the next trade. Trade psychology is fascinating. And what's really fascinating is seeing how you deal with a loss, or seeing how you deal with a series of losses, because you should always be doing a kind of a post-trade analysis, having a think about what you got right, what you got wrong, being honest with yourself, were you lucky, were you unlucky, and then going from there. Just this week, US inflation data came out stronger than expected, and yet gold is down. How can this be explained? I've already covered gold, but I will come in on that again. I know exactly what you're going to talk about, and it's the old classic line: gold is a hedge against inflation. I mentioned a while ago that relationships in the financial markets don't always last. They can last over a 20, 50, 100-year period, but they don't necessarily last every single day to day. And right now, what's going on? And I know what you're saying. If inflation is rising and they essentially depreciating the value of the cash you have in your account, why not have it as something like gold? It's a hedge against inflation. But the problem, but there are other issues. The other issues going on here. Really high levels of inflation typically warrant interest rate hikes, and interest rate hikes in the US means a stronger US dollar. Gold is traded in US dollars, so it's no coincidence that something like euro dollar is at a 20-year low, i.e. the dollar is at a 20-year high against the euro. So the dollar is strong across the board. The dollar, on the last chart I showed you, was the dollar at a 24-year high versus the Japanese yen. The dollar is red hot. Strong dollar hurts gold because gold is listed in dollars. Factor number one. Factor number two is bond yields. If inflation is running high, and it's running very high, it's over 9% in the US, the Federal Reserve was hiking interest rates as they've already done. If you trade gold, keep an eye on the US 10-year yield. The US 10-year government bond yield, whether that yield goes from say 3% to 3.1 or 2.9 or whatever it is, whichever direction it's moving, higher or lower. The US 10-year yield is basically kind of an indication of what the bond traders feel about interest rates. If the yield is rising, that indicates that bond traders feel that interest rates are going to continue to be hiked. If yields are falling, it suggests that traders are thinking bond yields, interest rates will remain the same, or perhaps even actually get lowered. So, as I was saying, going back 18 months ago, 2 years ago, when central banks had interest rates basically at zero around the world, that led to savings accounts producing basically no interest. It led to a depressed situation of government bond yields. Bond yields were like 0.4%, 0.5%. Some government bond yields were actually in negative territory. So essentially you lost money overall on the investment. And back then, we also had a very weak US dollar, because guess what? The Federal Reserve wanted to intentionally depreciate the dollar as a way of actually boosting American exports, as a way of strengthening the US economy to rebound from the kind of lockdowns induced by the pandemic. Now, back then also what we had was a scenario whereby people were saying with their the pool of cash they've pegged to be in the kind of safe haven category, that they're very low risk category. Why would you have it in a bank account where it basically earns zero interest? Why would you have it in government bond yields when yields are 0.5% or in some case negative? I'll have my money elsewhere, be it stock markets or be it gold. Now things are changing. We're seeing, when you're hearing headlines like the dollar is at a 20-year high versus the euro, the dollar is at a 24-year high versus the Japanese yen, there's a broad strengthening of the dollar. And for the time being, at least, it doesn't look likely that rally in the dollar is going to come to an end. And if that means the dollar is going to continue to get stronger, you can't discount the possibility of gold becoming weaker and weaker. Why did also euro rally today? Is it because it anticipates the hike from the ECB president? Yes. Later today is Thursday. Yes, this day next week we'll have the European Central Bank interest rate decision. Now, the European Central Bank have made it fairly clear that they're going to hike interest rates by 25 basis points. They give us a pretty good indication that they might do a larger hike in September. Some people took that hint as a larger hike in September as a hike of 50 basis points, but it could only be a hike of, say, 30 basis points or 40 basis points. But nonetheless, inflation in the Eurozone is already at an all-time high. Inflation in Germany was recently at a level, last seen almost 50 years ago. Yesterday, Spanish CPI hit a 38-year high. It's all going to go in one way. Prices are all very high in terms of inflation. High inflation typically leads to higher interest rates. And it's almost like, why did the euro turn around? Well, people are thinking to themselves, we've had 5 interest rate hikes in the last 6-7 months in the Bank of England. We've had multiple rate hikes from New Zealand, rate hikes from Australia, rate hikes in the US. Yesterday, the Bank of Canada had their meeting, and the economists were predicting a hike of 75 basis points, and actually turned out to be a 100 basis point hike. It was a 1% hike, larger than expected. So people are now thinking, oh, what if the Fed do a 1% hike? The pressure is now on the ECB. The ECB are the ones who got left behind. They haven't hiked at all, and everyone else around them is hiking. So now people are saying, who's going to be the one to move? And if people are saying, well, the Bank of England and the Federal Reserve and the likes, they spent too long sitting on basically zero interest rates, and then when they started hiking, quickly and at large amounts. So they're kind of looking at the behavior, the pattern of other central banks, and assuming the Eurozone is going to do something similar. This is what I mean about always be looking around you and going, what are other people doing? What's the price? On this chart here, what's the price action on this chart? Do certain moving averages, do support resistance lines, does the RSI, MACD indicator, do certain things repeat themselves? Because if they do, that makes it more likely that it'll continue on that pattern. What are, in this case, central banks? What are other central banks doing? Are they, they all started off slightly hiking slowly, but then when they got going, they really got going. And now people are wondering, perhaps the Eurozone is in a similar situation. And especially if euro dollar is below parity, it's fair to say euro is cheap against the dollar, because we know it's dropped to a 20-year low. And for a 20-year low, you could argue the sell-off has been overcooked, especially when we have a Fed meeting an ECB meeting rather, 1 week from today. I'm conscious that I've been talking now for 44 minutes. Any other questions, or else I'll look to wrap things up. For those of you who are on Twitter, I'll show you my details on Twitter now, my Twitter account. Feel free to get in contact. This here is my Twitter profile. My handle is @dmadden_equity, @DMADDEN_EQUITI. So feel free to get in touch on Twitter. Similar to the kind of analysis I've been providing today. I can't or won't provide any trading ideas or any advice, but I'll happily talk about what's going on in the markets, talk about the major themes, happily talk about what's going on in terms of the prevailing trend. Should the trend continue, it might target price points A and B. Should the trend change around, it could target zones X and Y. So keep an eye out. So if you're on Twitter, feel free to follow me. Feel free to get in touch as well. And like I said, and reach out and say, hey David, what do you make it silver, or whatever it is. Good question. Question about oil. I'll answer this question on oil, and then I'll look to wrap things up because I've already been speaking now for over 45 minutes. Before I show you oil, I'll quickly show you silver. Where is this? Here is WTI US oil. So the big picture view here is for oil. Now, hit a major rally here into late March, in the early days of Russia's invasion of Ukraine. We had a sharp pullback, had a fairly sharp rally here, but notice how the peak here of latest June didn't retest the highs of early March. That in itself was a warning. Okay, maybe the upward trend isn't going to continue. Since then, we've moved aggressively lower. You know, a downtrend is defined as a series of lower lows and lower highs. So a lower low, a lower high, a lower low, a lower low, a lower high, a lower low. We're now back to the levels last seen since February. So we're talking back down to kind of 5-month lows. And this is as a demand story. You know, I talked a fair bit about how there are concerns that the US economy is running out of steam and it could be heading towards a recession. Same with Germany, same with the UK, the Eurozone as a whole. You know, basically, the global economy is going down a gear. You know, we've had the likes of the IMF, the World Bank in the last few weeks and months lower the growth forecast for the global economy. If growth is lower, chances are the demand for oil will be lower. But you know, keep in mind, because supply of oil is still fairly squeezed, oil is only at a kind of 5-month low. Russia has been kind of frozen out of the oil market because of their invasion of Ukraine. OPEC are raising output, but in the grand scheme of things, a reasonably slow rate. It won't be until September before OPEC get back to their pre-pandemic levels of production. So, really, to be honest with you, oil is fairly squeezed in terms of supply. So that's why we've only dropped to a 5-month low. By contrast, let's take a look here at silver. Silver is an industrial metal, so it's obviously not the exact same as oil, but it's also used in the likes of manufacturing. And what goes on in the likes of oil, if economies are booming, you'll probably see oil and silver rise at the same time. If economies are falling, you'll probably see silver and oil fall at the same time. Whereas by contrast, silver recently fell to its lowest level since July 2020. Silver is at a 2-year low rather, whereas oil is only at a 5-month low. So silver 2-year low, 5-month low. So if you trade the likes of oil, I would always be keeping an eye what goes on with even if you don't trade silver or platinum or palladium or copper, I'll be keeping an eye on those industrial metals, because like I said, commodities as a whole, metals or energies, they broadly speaking tend to move in the same direction at the same time. So if you're wondering, you know, I like your point about saying, you know, is it finally going down? It's been slowly kind of breaking down the last few weeks. It wasn't even that long ago US oil fell to a 1-month low, and all of a sudden we're at a 5-month low. So I think between the strength of the dollar, concerns about the global economy are finally kind of chipping away at US oil. So if it do continue to move lower from here on US oil, where would I be looking to as potential support zones? Well, if you go back here to the kind of the price action seen in February before Russia's invasion of Ukraine, you'd be looking down toward these zones here, you know, down around just shy of $90 a barrel for US oil. Below that, down toward this zone here, around 87.22. Below that, down towards 86. These are levels that I'm looking out for. So kind of in the near term 90, the more medium term down towards 86 for oil. And then of course looking at a snapback, you know, once again looking at previous price action and trying to use it as a predictor for where a rally could encounter resistance. You know, if you follow the 50-period moving average around, excuse me, acted nicely as resistance here. Not perfectly, acted as support here, acted as resistance here, kind of acted as support here, acted as support here. So the 50-period moving average has an okay track record as either acting as support or resistance, and that comes into play around 97.70. So keep an eye for 97.70 to the upside, and if you break above that, $100 a bar will be the next kind of big psychological number to look out for. And on that note, I'll look to wrap things up because I've been talking now for 50 minutes. So I do want to thank you for everyone who's tuned in. Especially thanks for those who asked a couple of questions. It's always exciting to have a bit more kind of back and forth. And I look to wrap things up there. So everyone, have a good day and have a good evening. Thank you very much. You're very welcome.